This next panel, again, we're going to talk about tactical trading and government intervention. All the stimulus that's been going on the fiscal side, the very active monetary policy and low rate environment that we've seen really over the last, 12 years now. It's been a long time, and how does that affect trading strategies in our world and in our peer group? How are managers reacting to that? And to lead us through this panel, we have the guitarist from ZZ Top, also known as Rufus Rankin, with the incredible beard, man. I gotta tell you, like, I'm a hockey player. We're known for our playoff beards. I've never seen a hockey playoff beard anywhere near as good as your COVID beard. Granted, you had a head start, but it's spectacular. Take it away. Introduce our final panel here.
Hey, thank you so much. Being that I live in Philly, I appreciate the hockey reference. So like James said, we're going to talk a bit about government intervention and its impact on tactical trading. This is a topic I feel is very important. Doesn't get enough attention. And many of the places I do see people talking about, they're either saying just buy stocks and everything will be lovely, or buy gold and build a bunker. So we want to strike a balance there. So we have a great panel. And my apologies if I mispronounce this, but we have Kianga Daverington, who's the CIO and managing principal of Acre of America Partners. And she has a focus on applying blockchain technologies to solve problems in the agricultural sector. Interesting fact, Kianga, and I apologize if I mispronounce it, means sunbeam in the Swahili language. We have Larry Powell, the panelist I've spent a fair bit of time with over the years. Larry is the president of LP Institutional. And this is a consulting business that assists money managers interested in establishing relationships with institutional allocators. Many people recognize that Larry had a great career working with Texas Teachers and Utah Retirement Services, system for many years. They may not know he's a macro trader with over 25 years experience, and that he is an avid recreational ice hockey player. And then finally, last but not least, we have Markian Ziga. My apologies if I mispronounced that. He's the MD at Lighthouse Investment Partners, as well as chair of the Quant and Macro Committee. And few people would probably know that he spent his summers as a teenager playing what I would call football, but other people would call soccer in Brazil. And then finally, I'm Rufus Rankin. I am the deputy CIO and one of the founders at Ampersand Investment Management. I focus on multi-manager and multi-asset portfolio management. And my interesting fact is I was once a chicken cook in the lovely town of Jaco Beach, Costa Rica. So let's dive right in. Our first question is, what source of the many types that we see, what source of government intervention presents the greatest hurdles for tactical trading? And I'd like to direct this to Kianga first, please. Kianga, I think you're on mute. I'm sorry, we're still not hearing you.
Kianga's having some technical difficulties. I guess her laptop is saying her microphone is not working. So it says you're unmuted. If you could talk, just jump right in. Otherwise, I'll ask Rufus to just move on and see if you can get that sorted. Sorry, everybody.
Yep. Larry, perhaps you could kick us off, please.
Sure. I've actually been thinking about this quite a bit. In terms of government intervention, I guess the first question I've had, I know it's not, these questions probably didn't come from you, Rufus, but when you're talking about government intervention, are you talking about the Fed, or are you talking about like let's say Donald Trump tweeting and trying to convince the Fed to adjust rates, you know, go to a zero interest rate environment? Or are you talking about, you know, I don't know, the government getting involved in some way, shape, or form in the way we trade?
That's a fair nuance, and I would suggest we start with kind of the base level of analysis, which would be the Fed, the ECB, and other large government bodies, to start with, at least.
Yeah, I mean, I guess my philosophy has always been that the Fed serves a certain purpose, and you know, I think their primary role is to keep investors in check, right? Raise interest rates when investors get really, you know, euphoric or greedy, whatever you want to call it, on the market and bullish. And on the flip side, to, you know, to lower rates when things are ugly. The problem is it's been very difficult to do that because of the zero interest rate policy and how, you know, how low interest rates are currently. You know, the question is, what is the Fed going to do going forward? Now we're, you know, at 3,300 or 3,200, depending on what minute you look at it, in the S&Ps. After being down to 2,000, we've been trading between 0 and 2.5% on short-term interest rates, and we're closer to 0. So if the market were to go down, what is the Fed going to do? You know, at that point, and somehow the Fed's been able to pull tricks out of its hat, which go beyond lowering interest rates, or the government has. So, you know, I'm not sure. In terms of hurdles for tactical trading, I guess I've never viewed government intervention as being a problem for tactical trading per se. Maybe it affects other macro-like investors, but has, you know, never affected me. And maybe that's because I focus more on technicals than I do on fundamentals.
Okay. Well, it's interesting to think, okay, if the Fed, just to use them as the example, they run out of arrows in the quiver, so to speak, does this signal a reduction in their ability to do anything? And if they are in some fashion interfering with the success of tactical strategies, is that going to go away? Markian, what do you think about this?
Yes, I think it's an interesting question. I think Larry hit on probably the first two things that come to my mind when we talk about government intervention. So it's either those things that are on a prescribed economic calendar, such as a monetary policy decision and or a prepared speech. And I think on the other side of the spectrum, there is rhetoric that comes from political leaders. And so I guess, you know, maybe touching upon the first one, in terms of events that are on a calendar, I think I would delineate between tactical strategies that are discretionary in nature and those that are systematic. Because I think for those that are discretionary in nature, you know, they probably more often than not provide opportunity for those types of managers that are pursuing those types of approaches. And I say that from the perspective of, what is the objective function of government intervention? It's to correct some perceived imbalance and cause some type of convergence, or on the flip side, there could be a policy mistake. And so I think for a student of fundamental policy, you know, that could be quite an attractive opportunity. Now, for a system, on the other hand, that's trading a prescribed, defined set of rules, that might be a little bit more challenging. And I think those days when there's a Fed announcement or an ECB release, I kind of view those as more coin flip types of days for our systematic strategies. You know, in the short term, they may make money or lose money. Over the longer term, assuming that whatever intervention or policy decision was made results in a new trend, you know, I think over the long term, you know, that should be quite a positive thing. Just because we had hinted at it, in terms of answering your question, what do I truly view as the largest hurdles related to government intervention for these types of strategies? It's really anything that would cause a gap price reversal. And what I mean by that is some type of shift in sentiment that causes market price action that moves against you. And then it's particularly problematic when it happens when the markets are closed, such as during the weekend, or overnight when there's less liquidity, and you really don't have time to readjust your positioning or really trade in the manner to capture that type of price momentum. And I think, to belabor that point, what makes that type of activity even more challenging is when there's uncertainty. So I think Larry had mentioned, if a certain developed market president is tweeting about tariffs or interest rate policy, that could be problematic because that causes uncertainty. Similarly, more recently, there's a certain Latin American president arguing over social media with his economy minister about what they need to do with their fiscal deficit. So I think anytime you have that type of rhetoric out there that the market really doesn't know what to do with, and inherently there's whipsaw type of price action, that kind of, to me, is the Achilles heel for tactical trading approaches.
That makes a lot of sense. Larry, I'm curious if after Markian's comments, you think that the comments by leaders using Twitter and other social media platforms are potentially more harmful to, say, systematic versus discretionary strategies, or shorter versus longer term strategies?
It's interesting. I've been in this business for 35 years, and when I first started trading, was on the floor, and everything was technical. It was all about charts and support and resistance and things like that. And then when I started a money management firm in the late 80s, early 90s, I actually got introduced to fundamentals and analyzing relationships between equities, bonds, and cash. And that's the majority of what most tactical asset allocators, or historically, that they've looked at. And the problem is that when the Fed is really good at protecting the public when things get ugly, yet they're not very good, and they haven't been very good in the last 20 years in pulling the punch bowl, when, in other words, in raising interest rates. They've been afraid to raise interest rates. That creates a real problem in the relationship between stocks, bonds, and cash, right? So if you're just looking at stocks, bonds, and cash and yield relationships between those things, you've probably been bullish for 20 years. And, maybe you were bearish for a short period of time in 2007, but got right back in when the Fed jammed interest rates down. So I personally, in my trading, I've become more technical. So I've kind of gone back to being more technical than more fundamental, because the fundamental stuff just doesn't really work that well. So I think Markian's right about more discretionary managers maybe being more influenced by government intervention, but it also does create opportunities. But the Fed lowering, it's important in my analysis and stuff like that. In looking at interest rates, I think interest rates are really important. But I look more at the longer term interest rates than at the short term interest rates that, are more of an influence on supply and demand and people's, I guess, expectations of what the Fed might do, because the Fed is more reactionary rather than preemptive, or at least that's the way they have been recently.
Okay, thank you. So Kianga, I think we may have you back now.
Yes.
Great. We
Yay!
can hear you just fine. Yay! All right.
Sorry for my difficulties. Good afternoon, everyone.
Good afternoon. So would you like to weigh in on this first topic we've been discussing, excuse me, as far as what source of government intervention presents the greatest hurdles for tactical trading?
Yeah, I would say that the emergency situation that we're in, these sort of crisis moments, present a lot of the headwinds actually coming our way, and the sort of very radical adoption that we could see in terms of changes of policy. I know we've been talking about the Fed, and I don't want to jump ahead in terms of our talking points, but you know, we've talked about monetary policy and changes that are coming up in the banking system. You know, I've been involved in cryptocurrency and blockchain as an investor and as a trader for the last few years. Previously, I was a derivatives and commodities trading lawyer for the sell side, and have kind of seen the responses that came out of 2008 as well in terms of Dodd-Frank and now, and I think that behind the scenes, there's a whole new restructuring of our sort of monetary system that's underway, and particularly around the digital dollar proposal. And in fact, I think, you know, today there was even some statements from some Fed officials about a new currency, a new structure of the currency, a structure for payments. I mean, a lot of the changes are cloaked, I think, in language that, you know, may not be clear in terms of, like, I think what the impact will be. But this move that COVID and situations relating to the virus have given impetus to say, okay, well, let's get some legislation through in a jiffy that could have some really major impacts on the whole banking sector as it sits today, in terms of what the role and the structure of commercial banks will be, as well as monetary policy going forward.
Okay, so you kind of hinted where we're going, which is talking about what new things on the horizon. But before we talk about what the Fed and other parties are going to be doing in the future, it'd be nice to pause and say, how effective have they been over the last 10 or 20 years? Has the Fed, has the ECB, have these large structures, these powerful bodies, been effective in their mission or not? And if you could give a rating to some of them, like the Fed, what would you give them? Would you give the Fed an A or a D, or perhaps even worse?
You know, that question, really depends on where you sit and what their objective really is. I would give them, you know, an A++ in some respects, keeping the system liquid after 2008. Instability that we might see coming in the future, if you're not positioned for it, then, you know, some may argue that they've done a bad job. But I think if the goal is to kind of sustain asset prices and sustain the kind of broader flow of capital and credit around the world, then they've done a terrific job under the circumstances.
Okay. Markian, what do you think?
Yeah, so I think in terms of answering this question, depends on how you define what really is the efficacy of monetary policy. You know, I think the IMF would call it price stability, i.e. lower stable inflation, and then also managing economic fluctuations. So as it relates to the former, specifically inflation, maybe more of a mixed bag there. Clearly with AIT coming about, we'll learn a lot more as to whether a developed market central bank can really talk up inflation and actually create it. I think, to Kianga's point, as it relates to the latter, specifically managing economic fluctuations, you know, clearly they've been successful in terms of supporting risky asset prices. You know, I think in terms of moving unemployment lower, you know, you could say that they've been successful there as well. Maybe it's a little bit more mixed, or it took a little bit longer as it relates to wage growth for that to occur. I think, you know, probably where you could level the most amount of criticism is, you know, truly what are the impacts of a growing wage gap and the continued disparity there. But I think if you're solely evaluating them from the perspective of inflation and or just managing the stability of the economy, you know, I would agree. I think that they've had success to that extent.
Larry, what do you think about this?
I think you know my answer. You know, I agree with what Markian said about it all depends on what your view is, that what the job of the Fed is, and you know, and I suppose that depends on where you're coming from. And you know, I view the most important job of the Fed is to keep the markets in control, and whether that, you know, like I said, is, you know, controlling greed as well as controlling fear. And my grade would be C- on the way to F for that. I give them a high grade for, you know, for aggressively lowering rates and you know, being able to temper fear, but they've done absolutely nothing in the last 20 years in terms of slowing down and reducing, you know, greed and euphoria in the markets. And it all started back in 1996, in my mind, when Alan Greenspan came out with his infamous I don't know, expression or whatever you want to call it, of irrational exuberance. And to be honest with you, I was aggressively trading at that time, had a, you know, hedge fund that I was running. And, you know, maybe I'm somewhat biased in that he didn't get aggressive on controlling irrational exuberance. It seemed like he was more concerned with, you know, helping Bill Clinton, you know, have the longest period of time of, you know, a economically thriving economy, the Goldilocks economy. And, you know, from that point forward, it's been very difficult for the Fed to kind of control the market, and their influence has dropped significantly, you know, since then, particularly in controlling the, you know, the downsides of the market. When you think about 2008, it wasn't the Fed lowering interest rates. They lowered interest rates, the market dropped 50%. It was really the TARP program and some of the other programs that were, you know, that were introduced by the government, other, you know, parts of the government that, you know, helped protect the market from just going to zero. I mean, in my mind, you know, and so anyhow, that's my grade, C- on the way to F.
All right, well, you could pass with a C- still, I think, at some schools. Kind of transitioning into what's next, it's been a pretty good play just to buy dips in equity markets over the last several years. So that's been helpful, at least for some traders. But, you know, thinking about what money is and how most people, at least in the last 50 to 100 years, have thought of money as paper, right? The stuff in maybe you have in a wallet or that you use for physical transactions. Well, there's been a lot of impetus and motivation, for example, at the ECB with COVID and negative rates in China. There's been a strong move away from paper money. So moving forward, you know, I'm starting to read about how the Fed is considering a move into some version of a digital dollar. I read that a couple of former members of the Fed are proposing a digital type of stimulus. So where are we going next? Is paper money going to go away? What is this going to do to the American financial system and globally, Larry?
All right, bring it over to me. You know, I think I'm probably the least qualified person on this panel to talk about cryptocurrencies and other digital currencies, since I've pretty much been of the belief that Bitcoin is a Ponzi scheme, and we're never going to go in that direction. I'm probably wrong, but I guess I've learned a little bit about blockchain and some of the reasons that so many firms have put quite a bit of money. Some really smart investors have allocated quite a bit of capital to that space. So there's got to be something beyond cryptocurrencies to the whole blockchain thing. And I think that the only way that it's going to work, and I think what makes me the most skeptical of cryptocurrencies is the lack of regulation. I guess if various government institutions and regulators got involved in in controlling some of the things that are beyond our control, such as money vanishing overnight, and protecting capital, things like that. Know your customer, money laundering, all that stuff that is part and parcel with what cryptocurrencies have been. I don't know. Those are the only comments that I really have about.
Well, sure. I think you share those views with a large number of people. Kianga is the crypto expert on this panel. I think you and I read the same article this morning about the proposal for the Fed to just give every citizen digital dollars of some version in the circumstances of another crisis or emergency. So what are your views on all this?
Yeah, well, that's been in the works for quite some time. And in fact, there's the cryptocurrency or blockchain space is very well regulated in the sense that both the SEC and the CFTC over the past couple of years have issued a lot of guidance as to how to interpret our current laws and how digital assets should be evaluated in terms of whether they may be currencies or securities. In fact, I think it was maybe today or earlier this week that the OCC issued a ruling regarding the ability for national banks to hold stable coins. And in July, a similar sort of no action letter was issued confirming that regulated banks can hold cryptographic keys. And along with the ruling about stable coins, the SEC also commented just confirming that certain stable coins would not be securities, but of course it depends on the facts and circumstances. So these things have been done very sort of under the radar, but in terms of regulatory clarity that's been provided both at the Treasury level, Securities Exchange Commission, the CFTC, what we can actually glean is that a structure is being put in place whereby citizens, the retail market could have accounts directly with the Federal Reserve. And this Congress, members of Congress have jumped all over this during the pandemic as a solution for the unbanked, for getting stimulus directly to people. So it's become, I think, politically acceptable or sexy to think about blockchain or digital assets and other just sort of digital new payment forms. And this raises question in terms of sort of government intervention, the topic of this panel. What does that mean for commercial banks? And if there's going to be some kind of, and to the question of the panel of someone that's asked about paper money, I kind of am anticipating a new dollar, essentially, that would be a digital dollar. MIT and the Boston Fed have been researching different open source blockchain projects and have said that they're more likely to use something that already exists rather than try and create the technology from scratch. And it's likely, I think it's likely that we'll see, you know, announcement from, you know, all of the major banks that, you know, you can open a blockchain account and you can convert your paper money to these new digital Fed dollars, and that these will be made available at post offices. I mean, this is spelled out in a new regulation that's been proposed with the Banking for All Act that hasn't been passed. But you could imagine that if there's some other turmoil, if we have some problems around the election or this fall, and there's another opportunity to push forward some very bold legislation in a quick amount of time, that some of these things might actually get passed. And this could really help the Fed with a new wave of monetary policy to get currency circulating. You could have those digital dollars kind of set to expire at a certain amount of time. I mean, some people have proposed that. So they'll have a lot more tools with a totally digital currency system. And I think that's where we're headed.
So given the speed at which the US federal government moves, we could probably expect to have a digital currency in 300 to 400 years, right, Markian?
Unless there's another crisis.
Unless there's another crisis, which could be a strong catalyst for motion in this direction. And I hear a lot of concerns about security and things like money laundering, things like that with crypto, but it's my belief from the little bit I've read that you can actually have more security with blockchain than the traditional banking system we have now. Markian, I think we have a pro and a con so far for this. How do you see the development of, you know, paper currency and where we're going with potentially having a digital currency and what that impact that's going to have?
Yeah, so Rufus, by no means would I say that I'm an expert in this space either, but you know, I'd like to think that the advent of the digital dollar would mean a more effective system, more transparent, more secure, and more efficient American financial system. I think, you know, the current COVID environment clearly lends itself to fast forwarding the use case of applying that. I think both from the perspective of, you know, fiat currency or paper money spreads germs in the same way that we probably don't want to shake hands in the current environment. Like, do you really want to take that risk? So I think that helps from that perspective. But I think more broadly, in terms of, we're hinting at unconventional monetary and fiscal methods that the government might pursue in the future, and being more efficient in those methods. There are actually use cases where, you know, blockchain technology has been used in emerging markets to pass out goods or pass out money to those that are in need. And I think, you know, more broadly, if I was to think about, you know, what truly is in the best incentive of the Federal Reserve and the government here in the US, you know, I think the goal would be to maintain the US dollar as the reserve currency of the world. And I think, you know, if they don't seriously consider the benefits of cryptocurrency, or some type of digital dollar or stable coin, or, you know, whatever direction we ultimately go in, you know, they really fall at risk of falling behind China, and, you know, potentially the technology war that we're in, you know, with that type of a sovereign. And I think, you know, really, where does it ultimately matter? You know, here in the US, we're lucky enough that it's easy to open a checking account, to have a banking account, to gain credit. You know, there are many parts of the world where you might have access to a phone, you might have access to the internet, but having access to credit isn't the same thing. And so whether it's Bitcoin, whether it's Libra, or whether it's some type of other stable coin, it makes a tremendous amount of sense, you know, to give people, you know, that livelihood, that ability to improve their lives and to transact accordingly. So, you know, I guess answering your original question, Rufus, you know, I think I'm definitely more in the pro camp. I think there's a lot of benefits just from an efficiency standpoint that make complete sense to me. Now, there are inherent interests in the system as it currently stands that may block some of those interests, but ultimately, it just makes too much sense, and you have too many smart people focused on it for it not to work in some form or fashion. I think the last comment I would make is, because it's also been hinted at in some of the responses, is, I think there is some type of negative stigma around Bitcoin or other cryptocurrencies and being used for nefarious purposes, which I think is just kind of funny, because if someone tries to hack Twitter or to hack any type of system and asks for a ransom, if they would have asked for the ransom in US dollars, no one would say, oh, it's a US dollar scam. But if they ask for it in cryptocurrency, all of a sudden it's a Bitcoin scam, where really that's just the mode of transaction.
Thank you. That makes a lot of sense. I think we're winding down to our last 2 or 3 minutes. So the last question for the lightning round, so to speak, I'd like to leave with is, we've painted this backdrop where there is some expectation that perhaps the Fed and other central bank and government institutions are running out of things they can do in the case that we have another crisis of some sort. We are seeing some indications that digital currencies are leveling the playing field and perhaps improving efficiency and opportunities in a lot of parts of the world. What would you suggest, people, prudent investors should be looking at for the next few years? It could be a trading strategy or an asset that perhaps wouldn't immediately come to mind for some of the people watching the panel. So I'll start with you, Markian.
Yeah, so look, if we had a crystal ball, I think our jobs would be much easier, but
so easy.
What am I constructive on? I think everything that we're talking about as it relates to government intervention, even the current goals of the Fed, we've touched upon technology. We haven't really talked about demographics, but I think that's all intertwined with all this. I think you can make an argument as to why inflation could occur in the next 1 to 3 years. You could also make an argument as to why it would not. I think in either situation, it means while there may not be volatility in the deflationary scenario from a nominal rate perspective, there are things to do as it relates synthetically from a real rate perspective, and what that means for precious metals, what it means for other avenues, but then also what it ultimately means for currencies and potentially volatility that we haven't seen for quite some time. So I think, maybe I'm preaching to the choir a little bit. I do think that is more of an exciting development for macro, both discretionary and systematic, just that you have things moving around. And to that extent, we've seen that already this past year, just the amplitude of price action and the things to do on a daily basis and dislocations. And I think, rightfully so, there's been a healthy amount of concern about the effectiveness of certain central banks. And, when policy mistakes do happen, that could potentially create even more opportunity. So I guess that's a broad answer, but I guess that's the way I'm thinking about it, Rufus.
Indeed. I think we're about to get the shepherd's crook. James, should we wrap it up, or do we have?
Hard assets, out of the dollar.
All right. Larry?
Thank you for that parting thought, Kianga. Sorry, we don't have a buffer on this panel, and we got to get Nate to drop some knowledge on yield point. But I thank you all, and I especially thank Rufus for his pretending like he doesn't have a crystal ball when he's actually a wizard. But yeah, look at that beard. Yeah. That's amazing. That is amazing. Thank you all. Hope to see you at the December event too.